All right, everyone, it's a little bit after 10, so we're going to go ahead and get started today. Thank you for joining us for today's webinar, Special Accounting Considerations for Nonprofits. Today, we're going to talk about in-kind, unrelated business income, and special events. My name is Audrey Sadison, and I'm a member of DWD's nonprofit team. Before we get started, I want to share a few housekeeping items. The webinar will be recorded and is available on our website after the conclusion of the webinar. Today's slides will be emailed to each of you as well after the webinar. If you have any questions during the webinar, go ahead and submit them through the Q&A screen. And we'll try to answer these as we go, but if we don't get to your question during the webinar, we will follow up with an email to you. Also joining us today are fellow nonprofit team members Tyson Moore, Bill McKenzie, and Carrie Minnick, who will be presenting. And now let's get started.
Thank you, Audrey. And thank you everyone for attending today's webinar. Today, we're going to talk about some special accounting considerations that are unique to nonprofit organizations. I know there are some other ones like promises to give and endowments and restricted net assets and such, but we're going to focus on three specific areas today. In-kind contributions, unrelated business income, and special events. So it's really important to make sure you have a good understanding for these three different types of things that we're going to talk about today, because we really want to, as an organization, not only reflect your true financial position by including all of those in-kind contributions, but we also want to maintain IRS compliance and tax exempt status, making sure we're following all the rules if we do have any kind of in-kind unrelated business income or special events. But then also make sure that we're providing transparency to the donors and stakeholders of our organization. So first topic we're going to talk about is in-kind. So when we talk about in-kind contributions, we are talking about non-cash contributions. So not checks, not Venmo, PayPal, cash. We're not talking about those items. We're talking about those non-cash contributions that sometimes donors make to your organization. These really are part of your organization's operations. If you normally didn't have these donated, you would probably have to go purchase these. So it's a nice benefit that somebody is donating to these organizations, so you don't have to go out and purchase these items. So that's one of the reasons why we want to make sure we record these properly, because without these, we're not representing the true cost of our organization or the true support that we're getting from the community. So when we think about in-kind contributions, some of the different things that we think about normally are inventory. So if you, sell food or clothing or medical supplies or give them away, those kind of inventory types of items. You could receive property and equipment. It could be land, it could be vehicles, it could be office furniture. You could receive donated facility use. So that would be maybe where your organization's main office is. Maybe you're not paying for that. Or maybe you provide a programming offsite somewhere and you don't have to pay for that. Or, even maybe meeting space or that type of thing. You may receive donated labor and materials for construction projects. So if you have a big capital campaign going on, or maybe you're just adding a small shed in the back of your organization's location. So those types of things. And then also professional services, whether it be accounting, legal, some type of service that requires some kind of professional degree in education. So those are obviously not all encompassing of the in-kind that you could receive, but those are the more common ones that we see. So when we think about, we're just going to kind of go through these step by step, the different categories. So the first is inventory. So when we talk about inventory, again, those are items that you are going to get, that you're going to receive, that you're more than likely going to sell to someone else. And so when we get these, we really need to record these at fair market value. And so today, when we refer to fair market value, that is the price a willing buyer would be willing to pay. And so we need to make sure that we figure out what that fair market value is. And so for inventory, we can determine what that cost is by looking at various published catalogs, vendors. Maybe we contact a vendor that actually sells a similar item and ask them how much they would sell that for, or independent appraisals. Sometimes for inventory, we just really can't value it. So there are some other types of ways to value inventory. And what I have on the screen there, either the average value per pound or subsequent sales. That is usually used by either like a Habitat for in their resale store or maybe Goodwill when they get a lot of donated items that they're going to resell, but they don't have the ability or just cannot value each one of those items individually. So instead of looking to see what that fair market value of is of that item, they're going to do either an average value per pound or a subsequent sale. The point here for inventory is that you need to figure out somehow a reasonable way to determine what that fair market value is of your inventory, because we need to record it on our books as an asset. And again, when I'm talking about these journal entries, so this is, you're going to record these in kind if you follow GAAP, if you follow the accrual basis of accounting. If you follow the cash basis or the modified cash basis of accounting, you are not going to record these actual journal entries on your books. However, at the end of this section, we're going to talk about what you need to do. You still need to track the in-kind that you do receive. So if you follow the accrual basis of accounting or GAAP, then you would record this journal entry to record donated inventory. You would debit your asset account of inventory. Let's say it's a $1,500 value, and then you would credit in-kind contributions because we want to show that contribution coming in. So next, let's talk about property and equipment. So again, these are items that are going to be capitalized on your books as an asset, so not an expense. So this is going to be buildings, office equipment, land, vehicles, those types of things. And so again, we record it at the fair market value. Again, the price that a willing buyer would pay. So when you're looking to determine how you should record these items on your book, again, using the vendor invoice. For vehicles, Kelley Blue Book, looking that value up online. And you have to remember that when you are recording property and equipment, we want to make sure that we include all costs that are necessary to place the asset in use. And that's true if we're purchasing it too. So for example, shipping, if we had to pay for shipping to get this item to us, then that would be included in the cost. Some things I do see sometimes for like if you buy new computers or computer software, sometimes there's some additional training on the actual software that would not be included. That training piece would not be included as part of the capitalized asset. Obviously, it may be necessary to use that additional software, but it wouldn't be included in the cost of the asset. So okay, let's say, for example, we have a vehicle that's donated to us. We look it up on Kelley Blue Book and determine that the value of a comparable model of that vehicle is $2,500. So we're going to record it on our books as an asset under vehicles of $2,500 and as an in-kind contribution for a credit of $2,500. So next, let's talk about facility space. So again, this could be like your main office space that you're not paying for, or it could be an offsite somewhere else. You provide programming somewhere, and you don't have to pay for that. Maybe it's like at a church building and they're offering that space for free. Any kind of space that your organization is using that you don't have to pay for would be considered in-kind facility space. And again, we want to record it at the fair market value. So for facility space, to determine that fair market value, one thing you could do is ask the lessor, ask the people that you are using this space from, hey, if we were going to pay for this space, how much would you charge us? You could also look for comparable rates. One of the websites that we use sometimes is loopnet.com. You just need to make sure that when you're looking at comparable rates that you're using a similar type of building, whether it be like a retail space or a warehouse. Those obviously have different values, whether it's finished or not on the inside. But then also you want to make sure the similar area that you're using. So obviously, if you have in-kind space in Fort Wayne, you don't want to look up at a comparable space in Indianapolis because that just wouldn't be reasonable. When we're talking about donated space, sometimes it could be partially paid for and partially in kind. So for example, maybe you do have an office space that you pay for month to month, but the amount that you're paying isn't fair market value. So like they're giving you a discount because you're a nonprofit. They're saying, hey, we would normally charge $2,000 a month for this space, but because you're a nonprofit, we like what you do. We want to support you. We're only going to charge you $1,000. So in that instance, you would record the $1,000 that you pay as, cash going out and as an expense, but then you would have to record the difference of that $1,000 between the fair market value of $2,000 and what you're paying as an in-kind. And so for example, here, let's say we have $1,200 or 1,200 square feet at $15 a square foot. So that's $18,000 total for rent. So we would record that on our books as an expense of $18,000 and then as a donation, a contribution of $18,000. Next, we have supplies. So again, these would be items that you're using in your organization. So whether it be office supplies, paper, maybe some programming supplies, again, things that you're using within your organization that you wouldn't have to pay for, somebody donated them to you. We want to make sure we record these because that is a true cost of providing our programs and services. So again, looking up the item online to see what, if you went to the store to purchase it, how much it would cost, or contacting the vendor to see how much they would charge you for it. We would record that at the fair market value as a supplies expense, and again, as a in-kind contribution. And then auction items. This is a little bit different. So those are the items that you receive for your annual fundraising auction at your special event. So a lot of times nonprofits will have a dinner and an auction, and they will go around and get trips or signed autograph memorabilia or different types of things. And so a lot of times the donors will donate these items to the nonprofit. And so we really want to make sure we record these as well because you didn't have to pay for these. So this is a part of what you're doing. So let's say, for example, someone donates us a really nice watch to put up for our auction. And let's say that donated watch has a fair market value of $1,000. So when that donor makes that donation to us and says, here, I want to give you this watch for you to sell in your auction, you're going to record it on your books as an asset for $1,000 and as a donation for $1,000. Now, when you come to the actual auction, sometimes items sell for more than what they're valued at, and sometimes they sell for less. We obviously hope that they're sold for more. So let's say that watch of $1,000 sells at your special event auction for $1,500. So we need to record that transaction on our books. So we're going to record $1,500 in cash because that's what was received. We're going to credit the asset of $1,000 because we no longer have that asset. We sold it. And then we're going to record an additional in-kind contribution of $500 because we received more than what that value of that watch was for. Now, let's say, unfortunately, the watch sells for less than $1,000. So it's valued at $1,000, but it only sells for $750. So instead of that transaction for $1,500, we're going to record cash of $750. That's the amount the person at the auction paid us for. We're going to remove the asset for $1,000 because we no longer have that asset, but we're going to debit the in-kind contributions for $250. So that means that we're going to reduce that initial $1,000 contribution down to $750 because it only sold for $750. So again, just making sure that we're recording all of those properly for our auction. So those were like the physical items that people could donate to you. So let's talk about services. So only record services if two things. They either create or enhance a non-financial asset, which means a fixed asset, or they meet all of the following criteria. And these three criteria need to be met. The service requires specialized skills. The service is provided by individuals who possess those skills. And the service would typically need to be purchased if not contributed. So what does that mean? So for example, if you receive, if, let's say you need some legal advice and you need to pay an attorney. So if, let's say this attorney decides to do it pro bono and gives you this in kind. So an attorney, they require specialized skills. They have to go to school, they have to pass the bar exam. So they require specialized skills. This attorney has those specialized skills, and you would have to pay for it if they didn't contribute it. So you would record those legal services on your books as an expense. Now, if you have people coming in, volunteers coming in that are answering phones, that are stuffing envelopes, that are, cleaning your office, that's great. Those are things that you need. However, they do not meet the criteria of specialized skills. So therefore, they would not be recorded on your books, actually in your accounting. Now, you should still keep track of them outside your accounting, like in an Excel spreadsheet or Drona software or somewhere else. You should still keep track of that, but they don't meet the requirements to record them for accrual basis GAAP accounting. So we wouldn't record them actually in our accounting. So it's just those main professional services, accounting, legal, marketing, other types of services that require some kind of specialized skills, some kind of additional education to get those skills, and that person is providing to you. Now, the first one, the enhancing the non-financial asset, again, that's more of like fixed assets. So for example, you have a construction of a building, and let's say you have a group of people coming in and they're going to donate their time to construct this building. This does not need to be skilled or it can be skilled or unskilled. It doesn't need to be necessarily someone that just builds buildings. It could be volunteers that, are accountants or lawyers, and they're coming in to help build this building. So you would record the value of that construction on your books as an in-kind. Now, we wouldn't record it at, like, for example, let's say an attorney comes in and they are going to help construct this building as a volunteer. You're not going to record their hourly time at their attorney rate of $500 or whatever it is. You're going to record it at a comparable hourly rate for someone that was constructing a building. So again, we would capitalize that. So their time and any kind of construction materials that would all go on the books as a building, as a fixed asset. And then we would record the in-kind contribution as such. Again, professional skills, you can record at the fair market value. Normally, if you have a professional that's providing services, they usually are able to provide some kind of invoice that would say, if we were charging you for this, this is how much it would cost. However, if you don't have that, you can also go to the U.S. Bureau of Labor Statistics website, and they have on their website, it lists all different kinds of professions, different industry, and you can look up like an hourly rate to determine how much in-kind should be recorded. So if you have somebody that is a nurse and they come in and they volunteer 20 hours a week for your organization, you can go on the U.S. Bureau of Labor Statistics website and look up nurses and see what their hourly rate is and take that times the number of hours and come up with an amount. So again, making sure that you have some kind of documentation to support the rate that you're using. So again, if you have professional fees, for example, legal fees, you would record that donated time as an expense, for example, legal fees, and then you record an offset in-kind contribution. So again, there are some items that are donated to the organization that are not recorded. And when I say not recorded, I mean not recorded in your accounting. You should track all of the in-kind that you get, all of the volunteer, but these items on the screen here are specific items that are not recorded in your accounting. So items that are not used or sold by the organization. So for example, if you're a homeless shelter and you get a bunch of hygiene items or food items that are distributed to the clients, you're really considered a pass-through there. And so you don't record those items on your books. items that have no value. So let's say a business is going, there's a company and they're going out of business and they have a bunch of office furniture and it's pretty old office furniture, but it's still usable, still looks nice. And they say, hey, we want to just give this furniture, we're not going to sell it, we're just going to give it to nonprofits. So normally that furniture probably doesn't have a huge value, and so normally wouldn't record that on your books. Again, we talked about services that do not require specialized skills, such as answering phones, stuffing envelopes, cleaning. Those do not get recorded, or services that you would not otherwise pay for. The example I like to use here is, let's say that the local college marketing class is their project this semester is to pick a nonprofit, and they are volunteering to develop a new logo for a nonprofit, and they're going to provide some additional advertising materials and such. And all of this is valued, let's say, at $25,000. And so your nonprofit, we say, hey, we want to do this for your nonprofit. And you say, that's great. We'd be happy to take that. So if you were not planning on paying $25,000 for advertising and you wouldn't have done this, you wouldn't have gotten this expense without this donation, you do not record it on your books because you otherwise would not have paid for it. It was just something nice that came along and your organization happened to benefit from it. And so that's why they gave it to you. So you don't record it on your books as in your accounting. When we're talking about in-kind contributions, we want to make sure that we have proper documentation, which is, for any of our accounting, we want to make sure that we have proper documentation supporting revenues and expenses, but specifically for in-kind, because it is a little bit different because there's a different way to value these, to put these on your books. So we want to make sure that our documentation includes the descriptions of the goods and services. So what is it that was donated to us? Was it 6 office chairs and a desk, or was it 10 hours of legal services? We want to maintain the donor's name and contact information. We want the fair market value determination. So how did we determine the value of it, and what is the value that we determined? The date we received it, and then also for construction of a building, we want to make sure we have all of those types of invoices, statements, those kind of things that support that. And one of the reasons is it's important to maintain these documentations because we do need to provide written acknowledgement to donors. So for those individuals that want to take a deduction on their 1040, they have to have some kind of support from the nonprofit. And so just in general, if you receive a contribution of $250 or more, that individual, if they want to take a donation, if they want to take a deduction on their 1040 for a donation of $250 or more, they have to have a documentation from the organization. That documentation needs to include the items listed on the screen. So this is for cash or non-cash. For non-cash, though, specifically, the organization must include a description, but not value of the non-cash contribution. So I see some organizations that don't really follow this correctly. You as a nonprofit are not to put a value of what was donated. You are just to include a description. It be those six chairs and a desk. That's what you put in. Thank you for donating to this. You do not put in the value. And then a description of good faith estimate to the value of goods or services, if the organization provided in return for the contribution. So this applies for those auction items. So for example, if I go to your organization's special event and there's a fundraiser, there's an auction, and I pay $500 for this auction item, and it is valued at $200, the thank you letter should say that, your contribution is only $300 and that $200 is the value of the item that you got. So you want to make sure that you're keeping track of that, because my contribution is not my full $500 because I received something in return. So we need to note that on there. So that way the donor can properly deduct only the $300 contribution. Okay, next. If you have an audit or a review done by an outside CPA, there are special additional disclosures that are required for these in-kind items. So in-kind contributions are required to be reported separately from cash contributions. So on your statement of activity, there should be 2 lines. one for cash contributions and one for contributed non-financial items. Also in the footnotes, it needs to talk about the programs and activities for which the in-kind was used for, whether it was for your administrative purposes or whether it was from your programming. If you monetized, if you sold the item. So for example, sometimes organizations receive a vehicle or a piece of land and they don't really want to maintain that. So they're just going to sell it to get the proceeds. So we need to disclose that. Any donor imposed restrictions on the items, the valuation techniques and input used to determine the fair value. So again, making sure that you're documenting the fair value that you determined that item was for and how you determined that. So again, this is one of the reasons why it's so important to maintain that documentation. And also one of the last thoughts related to in-kind, when you compare your financial statements on the accrual basis compared to your Form 990, there will be a difference for in-kind. For some reason, the IRS does not want in-kind services recorded on the 990. So in-kind materials and facilities, things that you can use up kind of are recorded in there, but in-kind services are not recorded on Form 990. So there will be a difference between your financial statements and Form 990. So I just want to leave this section with some common errors to avoid related to in-kind contributions. So if it doesn't meet GAAP, if it doesn't meet the accrual basis of accounting, don't record it. Again, those services that don't provide professional services and you wouldn't have to pay for it, don't record it. Or those items that are just pass-through items, don't record it. Or the opposite way, if you do get in-kind, make sure that you do record it if it meets the GAAP requirements. Not maintaining proper documentation and not providing proper donor acknowledgement. So making sure that you are keeping up on the paper trail for those in-kind items. So that's kind of an overview of in-kind. So next we're going to move on to unrelated business income. So nonprofits they're exempt from paying income taxes. However, nonprofits do have to pay taxes on unrelated business income. So we need to figure out what unrelated business income is first before we can know if we have to pay taxes on it. So this is the IRS definition of unrelated business income, and all three of these items must be met in order for it to be considered unrelated business income. It is a trade or business, it is regularly carried on, and it is not related to the organization's exempt purpose. Okay, so if those three items if they're met, then that means it's likely unrelated business income. Two things to keep in mind when we talk about unrelated business income. It does not matter what the organization is doing with the revenue that was generated from unrelated business activity. That's awesome that that money is going back into the organization to support your mission. However, the IRS does not care. The IRS only cares what the activity was that generated that income in determining whether it was unrelated business income. Just because you say, well, all this revenue is just going back to support our mission, so therefore it shouldn't be unrelated business income. That is not true. That's not how it works. Second thing, what is considered unrelated business income for organization A might not be considered unrelated business income for organization B. So it's not all across the board. It is on a case-by-case basis. And unrelated business income is a very, very gray area. So you really need to look at the facts and circumstances surrounding your activity. So let's go through each one of these three requirements first. First, trade or business. So what does that mean? An activity carried on for the production of income from selling goods or performing services. And when we talk about a trade or business, the IRS brings in this commerciality doctrine. So what does this mean? This basically means that if it looks like a duck and sounds like a duck, it's a duck. If it looks like a business and it acts like a business, it's a business. So the IRS actually uses this and courts use this in determining whether the activity is considered an unrelated business income. So if you are doing the same thing that a for-profit is doing down the street, you are probably going to be considered as having unrelated business income. So there's various factors that they look at when they are considering this commerciality doctrine, competition with for-profit. So if you are competing with other for-profit entities with what you're doing, probably unrelated business income. Pricing. If you are pricing it comparable to other for-profits, probably unrelated business income. If you're advertising, if you are advertising it out there like a business, and again, advertising like similar for-profit entities, probably unrelated business income. So again, if you look at your activity and compare it to another for-profit down the street, and it is very similar, you have similar type of clients, you are advertising in a similar type of manner, you are providing similar type of services or goods, it's probably going to be considered unrelated business income. It's probably going to be considered a trade or business. The third requirement is regularly carried on. Now, this could be a little bit gray. So when we think about regular carried on, we look at the frequency and continuity of how often this activity is carried on. So for example, if you're doing something all year round, like every day, that's regularly carried on. That's obvious. You're continuing to do that. Or like if you operate a sandwich stand one day a week, that's regularly considered carrying on. If you advertise for a solicitation for a publication that was distributed only on an annual basis, so let's say advertising is considered an unrelated business income. So let's say that you have once a year, you have this event and you create this publication, and in this publication, you sell advertising. So in order to put those ads in that publication, though, you have staff that are working all year round to generate those ads. You're trying to get clients all year round for people to pay. So because you are trying to generate advertising income all year round, even though it's only included in an annual publication, then that would be considered regularly carried on. Or for example, the sale of advertising for a concert that's only over an 8-month period. So again, the IRS looks to see how often the activity that is being used to generate this activity is carried on. Third, substantially related. So a business activity isn't substantially related to an organization's exempt purpose if it doesn't contribute importantly to the accomplishing that purpose. So if you have to look at your mission, and if what you're doing does not go and coincide with your mission, then that is not substantially related to your organization. Again, it does not matter if it's all going back to the revenue is going back to what your mission is. It's the activity that is generating that revenue. So the IRS does have some specific activities that are excluded from unrelated business income. They say if this is in place, then that activity that is generating income is not unrelated business income. So for example, volunteer labor. If substantially all of the work is being performed for the organization without compensation by volunteers, then it's excluded. So for example, a bake sale, or like a school where their parents volunteer to sell like the logo gear. So people are not being paid to do it. It's not employees, it's volunteers. So the IRS says because it is substantially all volunteer labor work, it's excluded from unrelated business income. Now, they don't necessarily give a specific percentage or requirement of what substantially all means. So you have to kind of interpret that. And what we're looking at is, hours, like, of the hours, are substantially all of them done by volunteers? Yes or no? Next, convenience of members. So if the IRS says that if this activity is being done primarily for the convenience of members or students, then it's excluded from unrelated business income. For example, a school cafeteria where the organization sells food to the students. So a school really isn't in place. They don't have an existence to sell food. They just happen to sell food at the cafeteria because it's over lunchtime. They need to feed the students. So it's for the convenience of members. And they say, therefore, that is not considered unrelated business income. And then finally, selling donated merchandise. So if, again, substantially all of the items are donated, then that revenue is not considered unrelated business income. For example, a thrift shop. So those are excluded activities. There's also specific exclusions for actual revenue. So like gaming revenue is not considered unrelated business income. Bingo, now there is a very specific IRS definition of what bingo is, but bingo is not considered unrelated business income. Distribution of low-cost items. So for example, like if someone says, we're raising money this year, and if you donate $100, then we're going to give you a mug, a coffee cup. Well, that coffee cup is considered a low-cost item. I'm not actually paying for that. I'm giving a contribution. That's just a low-cost item that is a thank you. And so that's not considered unrelated business income. And then qualified sponsorships, which we'll talk about in a little bit. There's also specific income exclusions. So for example, the dividends, interest, investment income that you earn on your savings account, on your investments, that is not considered unrelated business income, even though that's really not what your mission of your organization is for. Royalties, gains and losses from property. So if you sell fixed assets, your organization is not in the business of selling fixed assets, but that happens occasionally. The IRS considers that's not unrelated business income. Now, rents from real property. So in general, normally, if you rent real property, like buildings, space, then it is exempt from unrelated business income. However, there are some other things to think about there. So if you are renting real property like all the time, that's like becomes a major part of what you're doing, those rentals could be considered unrelated business income. So that's, again, a very gray area. So what is unrelated business income? So advertising, the IRS straight out says these are unrelated business income activities. Advertising. If you advertise in a newsletter or on your website and you get money, you paid for that, that is unrelated business income. When we're talking about advertising, we're also, it's not just, hey, thank you to our sponsors and you list their logos. That's not considered advertising. Advertising is has something to encourage people to go use those individuals or those businesses' services, like, hey, go shop at XYZ store. They're great. So you're encouraging them to use that. There's some kind of incentive for them to go to use that provider's services or purchase goods from them. If you are just listing your donors and saying, thank you to our sponsors, here's all of our sponsors, that's not advertising. Leasing, if you lease parking lots, if you're operating a coffee shop, I know this is a big one. In general, that is unrelated business income. However, some organizations, it might not be unrelated business income. So for example, let's say that we have a school and they have a coffee shop where parents and whoever wants to can come and buy coffee in the morning or after school. That has absolutely nothing to do with their purpose. That is probably going to be considered unrelated business income. However, let's say we have another nonprofit and their purpose is to help individuals that have recently been incarcerated and they are trying to help them now that they're back out of jail, and they're trying to help them get back into everyday life and get a job and learn skills. And so one of the things that they do is they operate a coffee shop. And within this coffee shop, they have these people that they're trying to help in their program work. So they serve coffee, they're learning how to run a business and that kind of thing. So in that instance, the coffee shop would not be considered unrelated business income. So see, I told you, it depends on the organization. And then finally, selling merchandise. So yep, if you sell your t-shirts and your coffee mugs and all those things that have your logos on it, that is technically considered unrelated business income. So again, need to look at the surrounding circumstances, but in general, these items, these activities are considered unrelated business income. So again, I just want to stop to one thing and say that, it's okay to have some unrelated business income. It's a great way to bring in additional funds to your organization. You just have to make sure that you understand that you do have to pay taxes on that. And you also don't want your unrelated business activities to be a major portion of your activities. The IRS doesn't like that. Because the IRS said, hey, you're a nonprofit and we gave you a tax exemption because you are doing XYZ mission. When you start doing these unrelated business activities, that's the same thing that this for-profit is doing down the street. This for-profit down the street has to pay income taxes. So that's why they implemented this unrelated business income tax, so that there's comparability between the two. But they're saying that if that unrelated business activity becomes a major portion of what you're doing, you're not really a nonprofit that deserves this tax exempt status. And so they may, at worst, take away your tax exempt status and say, hey, you're not a nonprofit anymore. You have too much unrelated business income. Again, there is no definition anywhere that says what too much or excessive is. It is just not supposed to be a major portion of your operations. So let's say that you do have unrelated business income, which again is fine. You just have to pay taxes on it. So in order to do that, you have to file a Form 990-T with the IRS, and you have to file a separate Schedule A for each distinct unrelated business activity. So, for example, advertising is one type of activity. If you have debt finance property, so let's say you rent building and it actually has a mortgage on it, that is considered unrelated business income, or merchandise sales. So those are three distinct types of unrelated business income. If you had advertising from something that you did at the beginning of the year on this publication, and then you had it at the end of the year on your website, those two can be added together because they're both advertising. You cannot add merchandise sales and advertising together. You can't net those two. So the IRS is very specific on siloing those different types of activities, because you can't offset let's say you have advertising and there's a gain, so there's net income, but you have merchandise sales and there's a loss. The IRS specifically says that you can't net that income and loss against each other because those are two separate types of activities. You have to keep those separate. So you'd have to file a Schedule A for each of the distinct business activities. And then there's a calculation that is done. So you take your gross receipts that are related to your unrelated business income, and then you're going to back out the cost of goods sold. You're going to back out direct expenses, and you're going to back out a standard deduction of $1,000 to come up with your net unrelated business income. And you're going to take that times the corporate tax rate to get the tax that you owe. And if you do owe more than $500, you do have to make quarterly estimate taxes. So again, it's okay to have unrelated business income. You just need to document it. Make sure you have documentation for all of these expenses that you're allocating against it, and you just have to pay taxes on it. Oh, you also have to file an IT-20NP with the state of Indiana for those of you that are in Indiana. And then other states, it just depends. Some of them are required to have a state return as well, depending on the dollar amount. You'll just need to make sure that you look that up for the state that you're in. Common errors to avoid: not tracking income and expenses by activity. So again, we really need to make sure that everything that's related to advertising is tracked somehow by advertising. Everything related to sales of merchandise is tracked by sales of merchandise. Unreasonable allocation of expenses. The IRS wants to make sure that the expenses that you're offsetting that income with are reasonable to that activity. And then again, I mentioned you can't net the income and losses from different silos. So that is unrelated business income. And our final section is special events. So when we talk about special events, these are obviously those fundraising activities to get people to engage with the organization and to give contributions, sponsorships, ticket sales. It's the galas, the golf outings, the auctions, the run walks, those types of things that generate this revenue. So there's different kinds of revenue that are going to be generated, and we need to make sure that we track them separately. So let's start with ticket sales. So let's say we sell tickets to come to our annual fundraiser, and the tickets are $150. Okay, so if you want to come, you have to pay $150 for a ticket. And we're going to say that we're going to feed you, and what we're feeding you, that meal is valued at $50. So this ticket sale it's an exchange transaction because they're getting something in return. They're getting a meal, but it's also partly contribution. So let's say $150 ticket. So we're going to record that in cash, and we're going to record $100 of that as the contribution and $50 of that as revenue. So again, $50 is the amount of the value of the meal. And then $100 is that excess that they paid, which is considered a contribution. So you want to make sure that you're tracking these separately because you need to record them on the Form 990 separately. Other types of exchange portions, aside from the meal. So like if there's a golf outing, that would be like the green fees, or if there's other types of things that the individual that is attending the event is receiving in return, what is that value that they're getting? That would be the exchange portion. Next is auction revenue, and we kind of talked a little bit about auctions earlier. So again, the auction revenues, if somebody pays for an auction item, it could include an exchange portion revenue, only that, or it could include contribution and exchange portion. So for example, let's say that in this auction, there is an autographed football and it's valued at $400. And let's say that it sells for $500. So you're going to record, again, the cash of $500, which you got. And then you're going to record the $400 as revenue and $100 as a contribution. Because again, it was valued at $400, but luckily the person paid more than that. So that extra $100 is a contribution. But let's say we only sold it for $400. Then we would only have that revenue portion of $400. Sponsorships. So I mentioned qualified sponsorships earlier, and those are specifically not considered unrelated business income. So under a qualified sponsorship, that is when the donor is making a payment to your organization to support your organization, your fundraising event, and they only get a name or logo recognition. So for example, in the marketing materials on your website, the things that are out there, you're just saying thank you to our sponsors. It's ABC company, and you shows your logo. That's a qualified sponsorship. Now, if they are getting advertising in return, that's different. That's not considered a qualified sponsorship, and that is considered unrelated business income. So again, when we're talking about advertising, there's some kind of call to action, some kind of price information that's available, something to try and get people to purchase their goods or services. That's considered advertising. So again, depending on what it is, whether it be a qualified sponsorship or an advertising, you want to make sure you record that properly, because we need to know, again, if it's going to be considered unrelated business income or if it's just a sponsorship. When we have a special event fundraising, we could receive in-kind contributions. And I already talked about that, but as under your special event specifically, the auction items are going to be in kind. You could receive in kind supplies. You could in food. Somebody could donate food to your fundraiser, or services. Like the auctioneers at the end that try and get the people to give more money for the auctions. So those types of things could be non-cash items that are contributed to your nonprofit for special events. And we pretty much talked about those. So when we are talking about special events, we talk about direct benefit to donors. And so those are expenses that where the individual, the attendee, is getting something. So it's the meals and the catering, it's the venue rental, it's those items that are specifically related to that event. Those are recorded as direct benefit to donors on your Form 990 in your audited financial statements or reviewed financial statements. They're recorded separately. Other types of expenses, like for example, your invitation, like the printing for the invitation, or like the printing for the reminder that it's coming up. Those are not necessarily direct benefits. Those are expenses, but they should be included as fundraising expenses. So again, those are costs that are related to like just organizing and promoting the event as opposed to specific to the event. Staff time, decorations, those kind of things. So they're all recorded as fundraising, except for these are recorded as in the fundraising column on your statement of activities and on Form 990, whereas these that are specifically direct benefits are not recorded on your fundraising column. They are recorded in a different spot. So again, that's why it's so important to document these so we know what kind of expenses they are, so we know how to properly record them on your financial statements and on your Form 990. So some Some reminders for accounting for special events. Record your revenues separately or somehow maintain them separately so we know how much is ticket sales, how much are the sponsorships and contributions versus how much is auction proceeds, because we need to record these separately. We need to report these separately on your Form 990. Track all of your direct expenses. Again, those are like the catering, the entertainment, the facility space, those things that are specifically related to the event. Again, just documenting all of these items, the revenues and the expenses, so we know what they are for and know how to report them, because we want to make sure that not only are we reporting them correctly to the IRS, but we also want to be transparent, be ready for our audit, making sure that the written acknowledgement to the donors is reported properly as far as whether it be a contribution or an exchange transaction. We talked about the $250 requirement. There's also a $75 requirement. So organizations are required to issue a written acknowledgement to a donor if it is a $75 or more quid pro quo contribution. Quid pro quo means that part of it is a contribution and part of it is a exchange transaction. So like that $150 ticket sale, that would be a quid pro quo contribution, and you would be required to disclose, thank you for your ticket of $150. $100 is a contribution, $50 is exchange, that's your meal, that's not deductible as a contribution. Okay, I want to talk real quick about the sales tax rules in Indiana, because they actually apply to special events. And in this, Indiana decided to change their sales tax rules in July of 2022. So in the past, there was a 30-day rule, then there was a $20,000 rule, now it's $100,000. So if you're a nonprofit organization that sells tangible items, that actually sells things of $100,000 or more, you have to collect and remit sales tax. Now, the state does say that there are certain types of organizations that this does not apply to, specifically churches and schools. And you can see here that these types of organizations listed on the screen right now, this does not apply to. But for anyone else, if you have $1,000 or more of sales, you have to collect and remit sales tax. This applies to things that are sold at special events. So, for example, this is from the Indiana Sales Tax Bulletin number 10, and I highly recommend that if you have a special event that you go and read these sales tax bulletins. If you're selling tickets that include food and drinks, and the fair market value of the food and drinks is $25, then the $25 is subject to sales tax and counts towards the $100,000 threshold. Now, there is an exception if you have a bundled transaction or de minimis test. So that's why I say it's very important that you go and read these tax bulletins. Also says, like, for auction items, if you have an auction item for sale and it includes a specific tangible items like a backyard barbecue that has a spatula and apron, like physical tangible things, those things could also be thrown into the $100,000. Please go to the Indiana Department of Revenue and look that up. I think this change maybe not well known by all nonprofit organizations. Obviously, some organizations are going to be way less than $100,000 in sales, but if you have large special events and you're bringing in over $100,000 of gross receipts, which includes ticket sales for food, or which includes auction items that are physical, tangible items, I would highly encourage you to go read these sales tax bulletins on the Indiana Department of Revenue's website. They have a lot of specific examples. They try to explain these changes. So I highly recommend, again, that you go and read these sales tax bulletins, because you may have to be collecting sales tax and remitting sales tax. So basically that, if you do have to collect sales tax, you have to register for a permit, you have to collect and remit the sales tax, and you have to file periodic sales tax returns. So some errors so again, just because I mean, it's been around since July of 2022, but they just didn't do a very good job of communicating that to everyone. And so I, again, just encourage you to read those sales tax bulletins. And if you have additional questions, you can reach out to us. But for special events, I guess some common errors to avoid is treating the full ticket price as a contribution when if there's a meal involved, it's probably not a full contribution because you want to make sure that that donor is deducting the proper amount on their 1040 as a contribution. Again, contributions versus exchange transactions, making sure you're tracking that correctly. Don't net revenue and expenses together. We need to track those separately. Recording your direct expenses versus your fundraising expenses, making sure those are recorded properly. And then also making sure that you're issuing the proper written acknowledgments to the donors, whether it be a contribution or a quid pro quo contribution, need to make sure that we're doing that properly. So that is special events. So I know I went through the last one kind of fast, but if you have questions, you can feel free to reach out to us. Just want to end by thank you for joining us today. If you'd like to learn more about, different types of nonprofit, whether it be nonprofit issues, whether it be board governance or accounting, special events, taxes, feel free to reach out to anyone on our team. We'd love to help you. We also have a nonprofit blog on our website that you can access that has all different kinds of topics. We also have our prior webinars recorded on our website, so you can go and access those if you'd like. All of this information is free. We want to make that available to you. We will be continuing to do our nonprofit webinars next year in 2026. We just haven't gotten those set up yet, but we hope that you will continue to follow us with those. And if you ever have any kind of topics that you think would be good topics for us to talk about, we're always looking for good additional topics because we want to make sure that we're providing information to you that you need and that benefits you. But other than that, again, just want to thank you for attending today and thank you for all that you do for your nonprofit and our community. Thank you.